Hello, everyone. Today on the Final Bar, we'll hear from Jesse Felder of the Felder Report. He'll talk to us about his overall take on the markets, particularly interest rates. Timely day to have Jesse on because clearly a lot of movements. If you're looking for a nice, calm, relaxed market environment in 2022, so far not the way things are playing out, with stocks coming down heavily, led on the downside by the NASDAQ and a lot of technology names. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a continually snowy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environments, and no better time than a day like today. I'm often asked when there's a big movement, do charts even matter, right? When it's a big interest rate move, Fed minutes, and that's what causes stocks to move. I would, of course, very biased as a professional technical analyst, but I will tell you charts are always an important part of the puzzle because it tells you not just about what's happening and not just about what might happen. It's really more about what actually is happening. This shows you how people are anticipating, are reacting to, are expecting, are disappointed by events like the Fed minutes today. So you see how the market is reacting. You see how growth stocks are coming down. You see how some of the more value-oriented parts of the market are doing a little better, and also areas like cryptocurrencies. There's sort of an untested market in this current environment. What is Bitcoin? What does Ether do when the Fed minutes come out and it's a little more, negative, a little more focused on what the Fed's changing policy than we might expect? We're seeing cryptocurrencies sell off pretty dramatically. So a lot of times we can think about a potential narrative, we can chart a potential course for what might come, but at the end of the day, the charts, the technical analysis will tell us what's actually happening, what's priced in, and what is unexpected. We have a great guest today, Jesse Felder. Excited to bring him on the show. Again, he was with us back in November, if I remember right. So it'll be interesting to hear maybe how his perspective has changed in the last couple of months. Tomorrow, we have Jeff Huge from JWH Investments in Minneapolis. Next week, three really good guests for you. On Tuesday, we have Bill Baruch, who's the founder of Blue Line Futures, joining us for the first time. On Wednesday, the 12th, Dana Lyons of the Lions Share Report. And then on Thursday, the 13th, Mary Ellen McGonigal from the MEM Investment Edge. We also have a lot of great New Year programming coming your way. Our first edition of a new show called Go No Go Charts will be premiering on Thursday of this week. We also have special market outlook events from Larry Williams, from Martin Pring and Bruce Frazier, and also our special Charting Forward 2022 Market Outlook featuring Tony Dwyer and many, many others. So a lot of great content coming. Keep watching Stock Charts TV and our on-demand platform, our YouTube channel, elsewhere for some great content. Let's continue on with today's market recap. And as I've mentioned on busier days before, certain days it feels like it's I'm looking to find things to talk about. This is not one of those days. I had to start trimming things that we're just not going to be able to get to, just given the severity of the move. And there's a big drop, obviously, this afternoon. The Fed minutes hit from the December meeting, and clearly the market reacting fairly negatively to that. With most risk asset classes, the only things that are really moving to the upside, even gold turned to the downside. There's not much that I'm seeing. You can see the same reports are. The only things that are up are things like interest rates, which happen because yields are going or bonds are selling off, and the VIX, which is telling you basically increased fear or uncertainty. But any sort of risk assets really coming off today. The S&P closing right around 4,700, down about 2% from yesterday's close. And yesterday was more of a choppy day. Today, started for the course of the day, the morning into the early afternoon, sort of flat to down, but not severe. But that really changed. The character changed significantly after 2 p.m. Eastern. The NASDAQ really pushing all the way down over 3% to the downside, and the S&P 100 mega cap stocks down about the same as the S&P. The VIX now back above 20. Other asset classes, we have 10-year yields back above 1.7, and we talked through much of 2021 about the overall, look of the interest rate chart. The dollar sign TNX is the main way we've tended to look at interest rates, looking at basically the middle of the curve. We talked about that 170 to 175 range as being the level of resistance from earlier, sort of mid-year 2021. This is before 10-year came down to around 115 or so, and now has round tripped all the way back to above 170. So we are very close to seeing a new high for rates for the last, 6 to 8 months, and now, maybe approaching the levels that we saw earlier in 2021 and in 2020. The dollar index, for what it's worth, flat from yesterday. Gold was elevated, was higher earlier in the day, but finished in the negative with the GLD down 0.3%. Commodities as a whole down pretty significantly. Energy stocks were about flat for the day. Cryptocurrencies, really, when you think about what cryptocurrencies are they a risk asset? Are they a safe haven? On a day like today, it's hard to think of them as any sort of safe haven because stocks are down pretty significantly and cryptocurrencies are down even more. It's almost like a higher beta play on a risk on asset. So Bitcoin down around 44,100, Ether just above 3,600. Let's look at some of the individual charts and talk about how the configuration is evolving, obviously very rapidly. On social media, I put out this daily chart of the S&P earlier today. It's changed quite a bit since I sent the note out a couple hours ago. But if you look at it, basically we talk about 4,700. I basically said 3 observations on the chart of the S&P 500. One is 4,700 appears to be the first line in the sand, the first line of defense if we would see any sort of weakness. Now, I was not expecting that weakness to come in the next hour, but that's certainly what has happened. But it's very interesting to me that we've hit support, at least at the end of the day, right at 4,700, right at that level that we've talked about. That's the level of resistance from November a couple times, from December a couple times. That was the level we finally broke above in mid-December, which indicated some renewed strength, some buying power, overwhelming the selling pressure that had been materializing in November and December. Now we're seeing the S&P pull back from 4,800 yesterday down to 4,700, losing about 100 points today. So overall, I would say, tomorrow through the rest of the week, that is certainly the level to look at. Pay attention to the 50-day moving average, not too far below as well. That has served as support through much of 2021. There was only one time when we really broke the 50-day. That was in September and October. All the other times, the pullback to the 50-day was the ideal buy point. So does that pattern of buy the 50-day and go to a beach and just relax with your trading? We'll see if that actually plays out through the remainder of this week. The 50-day currently around 46.70. If we would break that, given the severity of the sell-off today, 45.50, I think, appears to be the next sort of level. Similar sort of pattern where you had resistance, then a breakout, and the resistance becomes support. That often is a well-established level. A lot of market participants are going to key in on that as potential support, and I think it's an important one. That would be about a 6.5% drop from all-time highs, just above 4,800 earlier this week. I mentioned the chart of Bitcoin, and what I will tell you looking at Bitcoin is the weakness has been well established before today. So while the severity of the sell-off today may be a bit of a surprise, depending on how you're viewing things, overall the trend in Bitcoin, the trend in Ethereum has certainly been weaker rather than stronger. It's been more about distribution, particularly in the last couple months, than any sort of accumulation and opportunities for Bitcoin to bounce. So for example, at the 38.2% retracement level in November, failed soon after. That was a support level around 54,000. We're now down to the 61.8% retracement level. If you take last July and go to the high last November, a couple months ago, we've now retraced 61.8% of the way down. From a Fibonacci perspective, that's sort of the last level. That's your last level of support before you get all the way down to retest the previous lows. Now, I would always combine something like Fibonacci retracements with other disciplines, particularly traditional support levels. 40,000 big round numbers have tended to be very important. We see how we turned around 50,000 in late December. So if we would see further deterioration in Bitcoin, 40,000 certainly an important level that I would keep in mind, because that has come up a number of times. Pretty much every time we've traded around 40,000, you've seen a bounce around those levels. So I would be paying attention there. But certainly the distribution that we've seen continuing to play out today. We're going to get to breadth measures a little later. We have a whole segment on focusing on breadth indicators, and we'll talk about some of the common ones and maybe some less common ones if we have time. So I just wanted to finish off talking about just how sectors played out before we get to the break here. Nothing was up today looking at the 11 S&P sectors. Everything was down, but a couple of them sort of flat, sort of an unchanged from yesterday. Materials, utilities, energy, and really consumer staples not too far below the zero line. So these are fairly defensive sectors. That's not true. Utilities, certainly. Consumer staples, certainly. Materials are really more of a cyclical play. And if you look, the biggest gainer today in the S&P 500 was Nucor, ticker NUE. We talked about that a number of times because it at times has been one of the top ranked stocks in the large cap scooter rankings. It's not quite up there yet, but it's still in the top 5% of names. And look at on a down day when the market's selling off, look at how Nucor is actually rotating to the upside, testing new all-time highs with a pretty constructive pattern, I would say, overall to the price behavior, threatening new all-time highs. We're really testing the range of that top day from last August. Getting above 125 would certainly complete that rotation, and improving on relative strength as well would be encouraging. What's really not doing well are things like technology, which is next to last. Real estate was actually the worst performing of the 11 S&P sectors today. After technology, then you had consumer discretionary and communication services. So the FANG stocks really struggling, and we're looking here at what I call the fan mag names, those 6 names. Alphabet down almost 5%, Netflix 4%, Facebook 3.7%. What's interesting about those growth stocks, again, the severity of the sell-off today may catch you by surprise in terms of the amount that those lost value, but the trend overall in most of those charts has been pretty negative. We'll talk a little bit later on look at the social media ETF, which has been in an established downtrend well before today. So a good reminder to focus on the long-term trends. Let's take a quick break. We'll be back with today's guest, Jesse Felder. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the market action using the technical analysis toolkit. I was taught earlier in my career working with a lot of successful investors, traders, brokers, that the value of charts is that it tells you what the market is saying, right? It tells you the message that is embedded in the markets themselves. Instead of debating what could happen or should happen, let's focus on what actually is happening. As one of my mentors, Ralph Eckenpour, used to say, you can't restate price. Couple quick announcements before we get to today's guest. First off, we love to hear from you, particularly questions that come up as you are analyzing your own charts. We'd love to address your question on the air and point you in the right direction. Anything about the technical toolkit, about StockCharts.com, about particular tickers or charts that you're struggling with. Our email is thefinalbar@StockCharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'll hope to answer your question live on the air on our next mailbag segment on Friday. Also, go to StockChartsTV.com. Many of you have been checking out our on-demand platform, and we're so appreciative that you've done that. Please check it out if you haven't already. You can use your email address to set up a free account, start watching all of the great content on our website, our year-in-review content from the end of December, all of the market outlook stuff coming up this week and next week. It's really worth paying attention to. Also, on your mobile device, you can just search on the App Store for StockCharts TV on demand. I want to welcome on today's guest, Jesse Felder. Jesse is the founder of the Felder Report, now based in Arizona, and has been a regular guest on the show last year, and we look forward to a lot more great appearances this year. Jesse, welcome back.
Hey, thanks for having me.
So it's good to hear from you. We obviously have a lot of movement. I don't envy the fact when you're coming on as a guest and the entire world changes in the couple hours before you appear. But thank you for bravely following through with the guest interview today. We're starting with a look at the TNX. Obviously, the TYX, excuse me, the long bond yield. We've seen interest rates come up pretty quickly today, given the Fed meeting minutes. What are you seeing overall in the fixed income markets?
Well, I think these couple of charts are two that we've talked about in the past. To me, when I look at this just 1 year chart of the 30-year yield, it's pretty clear that rates have been in basically a downtrend for the last 9 months, and they're now breaking out of that downtrend. And so that's a pretty clear sign to me that we're potentially seeing a trend reversal off of those December lows to something, where we could potentially see rates climb higher, especially long end rates, going forward. And the reason that this is something that's important to pay attention to is obviously there's been a lot of talk about it in the last 24 hours, that these long duration equities, namely, the big growth stocks, big tech, are very, their valuations are very highly attuned to what rates are doing. So you get rates going down like they have done for seemingly forever, and that supports, or has at least supported, valuations of these stocks, which we've seen. These FanMag stocks that you pointed out have recently soared to their highest valuations in at least 10 years. And so they're very highly valued today, and that's been supported by low interest rates. But if interest rates are now reversing higher again, potentially pressures valuations. And in the next chart, you can really see how this works, is that when you have rates falling, it's really good for large cap stocks relative to small caps. So this is the 30-year yield in green, and then the black line there is the small caps, Russell 2000 ETF ratio to the S&P 500 ETF. So you can see when rates fall, small caps do relatively worse compared to the big caps, and vice versa. So now that, it's interesting to me that now that rates are rising, we're starting to see the large caps suffer. I mean, especially today, we saw NASDAQ 100 fall 3% plus, but there's still a huge gap on the right side of that chart there that shows that small caps should be outperforming. Now, to me, there's three potential ways this gap could be filled. One is rates, are going to come back down. This breakout is not a real breakout, and the downtrend is going to reassert itself. Or small caps need to rip to the upside and outperform to the upside, or large caps need to outperform to the downside, which is what we're seeing today. And from the looks of this chart, if that's the way it's going to play out, then these large cap stocks have only just begun to decline quicker than the rest of the market.
Sort of, if that mega cap FanMag trade starts suffering, it's hard to imagine that the S&P chart is going to look anything but fairly dismal, I would imagine, given the weakness that we've seen already. On a day like today, Jesse, help us take a step back a little bit and put today into proper context. When you're thinking about how 2021 ended, and you're not thinking of the beginning of the year, we're already having to deal with the prospect of higher rates and what that might mean. When you're looking at the S&P pull back to 4,700 like it did today, any key levels that you would pay attention to, or indications that investors should start to get a little more cautious, a little more defensive?
Well, you outlined them beautifully here. I mean, you see 4,700. It's always funny to me when you see prices, end the day right at a support level, they did today. It's more than coincidence. There's a ton of people who are watching this level. It's a pretty obvious support level, and suggests to me we could probably see a bounce or an attempt to hold here for a few days. But as I said, if rates don't reverse lower, you're probably going to see the S&P 500, NASDAQ 100, continue south for a time, and this really all kind of points to, obviously, the Fed minutes were another catalyst today. If we're going to see a more rapid removal of stimulus, removal of support in the Treasury market, to me, it'll be interesting to see if long end rates do continue to rise without that support from the Fed. And if so, it takes away that support from stocks at the same time.
We only have about 30 seconds left, Jesse, but if I could, I'd love to ask you, because last time we were on, we talked a lot about gold, actually, and potentially seeing some strength in gold. We really haven't seen it materialize. You saw a breakout, a potential breakout in November that fizzled. Is what you're seeing with interest rates or anything we've talked about, does that cause you to be more or less optimistic about what you're seeing on the chart of gold here?
Well, real rates are about as negative as they've ever been, which should be very bullish for gold prices. I think the one thing that's holding gold back is that for the last year and a half, nobody saw the need for a safe haven. Everybody said risk on. But now I do think if we're going to see a risk off period, this idea of gold as a safe haven could potentially come back into fashion. And it's fascinating to me to see gold hold up so well lately, even while the dollar's been so strong. So to me, that's a sign that maybe smart money, big time investors have been accumulating gold in anticipation of this shift to a risk off, and maybe investors deciding they do need a safe haven once again.
Jesse, it's great to have you on again. Really appreciate it. Happy New Year. We'll look forward to talking to you again soon. But until then, stay safe. All right.
Same to you, Dave. Thanks again for having me on. Always a pleasure.
That's Jesse Felder. Jesse's the founder of the Felder Report, coming to us from Arizona, and I love that sort of some of those observations. That chart, by the way, of the long bond yield, $ TYX, and small versus large. That is a fantastic chart. That's one of those, when I talk with Jesse, people that use stock charts arguably better than I do. I'm always a little bit humbled. I wish I would have found that on my own, but I'm glad people like Jesse could come on and share with some really good insights. That's a really important chart to watch, particularly how small caps really didn't participate in a lot of ways in 2021. Maybe we see a different sort of contour, different sort of character for the market in 2022. Great take there from Jesse Felder. Let's continue on with our next segment, banking on breadth. So we love to regularly look at some of the breadth readings and focus on some of the key indications here. And our Mindful Investor live chart list, we have a couple breadth charts that we look at, but here's an opportunity to just dig into a couple of those in a little more detail and focus on some of the trends. So this chart is an interesting one. I should caution you, we've obviously had a pretty good sell-off going into the close. Some of this breadth data isn't updated yet because we're aggregating that closing data and updating all of our indexes. So some of these are certainly going to change by the time you look at them later tonight or tomorrow morning. But it's worth looking at what the trends have been up until today. And when I think about the breadth using the cumulative advanced decline lines, that's where I often start thinking about market breadth, because this just tells you the broad benchmarks are doing certain thing. What about the individual stocks that make up those benchmarks? What are the members of the S&P or the mid cap index or the small cap index actually doing? And that's what these advanced decline lines basically aggregate, the movements of those individual names that comprise those indexes. I have two of these color coded green. That's the large cap breadth and the mid cap breadth, because they've both already eclipsed their highs from 2021. So just in the beginning of the year, both of those have made new swing highs and continue to make new all-time highs. Obviously, both of those most likely coming off once we get all the data from today's close. If you look at the New York Stock Exchange, a broader universe, and if you look at the small cap index, you can see neither of those not only have not eclipsed their November high, they're still below their high from last June. So when you think about the fact that the S&P has been on this overall upward trajectory, and we can see the sell-off there when the into the close today, these breadth readings, half of them have been confirming the most recent breakout at the end of December. The other half have not yet. And it's interesting to see that the market is selling off after some of these breadth indicators did not confirm that upside potential. In terms of advancers, decliners here at the end of the day, I'll refresh it here really quick one more time. Looks about 83% of the New York Stock Exchange listings were down today, only under 20%, under 1 in 5 were up today, which is a fairly negative day. That's one of the more negative days you can see if you look where we're at and just look to the left on the chart. It's only a handful of days in the last year where we've had that many decliners versus advancers. So this was certainly a washout day of sorts, as a lot of individual names were going lower. What's interesting here is 78% of the S&P as of yesterday's close remained above their 50-day moving average, almost 4 in 5 S&P members above their 50-day, 77% of the S&P members above their 200 days. So overall, those are fairly constructive breadth readings. As of today, when you see some of the sell-offs, I don't know how many 50 days were broken, but certainly it's going to look a little less attractive than it was today. But overall, these are still fairly constructive numbers. This tells you most stocks are in a fairly consistent uptrend, just like the S&P remains above its 50-day. Most stocks you could describe as doing that same thing if we look at the S&P 500. But what if we look at a little deeper list? So here we're looking at the New York Stock Exchange here in green. At the bottom in blue, we're looking at that S&P number. So how many, what percent of the New York Stock Exchange, a fairly broad list of stocks, how many of those are above their 200-day moving average? It's currently around 58%. The average here for the last 21 days is around 51%, literally 50-50. So it's half and half on the New York Stock Exchange. So while 3 in 4 S&P members are above their 200-day, only half of the New York Stock Exchange, a little more than that, above their 200-day right now. So that shows you that differentiation. It shows you how while the S&P is looking a particular way, the broader New York Stock Exchange not quite as healthy as the major averages may make you think. When I'm thinking about what would cause me to turn less optimistic about stocks, given the sell-off, the initial down move that you saw today. This is one chart I might look at. This is magnifying basically the new 52-week lows. Not many making new 52-week lows because so many stocks are fairly elevated, right? Look at how far the S&P would have to go to make a new 52-week low, right? This is going down to 3,700, losing another 1,000 points. So that's why there are very few S&P or New York Stock Exchange members making a new 52-week low. But you see how in November that all of a sudden started to accelerate, because not only was the S&P stopping its attempt to make new highs, a lot of individual names were actually already breaking to new lows. Another area to look at is the bullish percent index. This is looking at point and figure charts and determining how many of them are in a bullish signal or a bearish signal. As of yesterday's close, 73%, 72% are still in a bullish phase. When that gets below 70%, that's what's called a bear alert. That tells you while the trend in the market may still be positive, a lot of individual names are registering sell signals. And the only way you register a sell signal on a point and figure chart is if you deteriorate quite a bit, right? You have to make enough of a move to the downside to go to a new column and basically indicate a new downward thrust. So there has to be enough of a price deterioration on a lot of individual stocks to trigger that reading. We last saw that back here probably in June. We had an extended period above 70%. You rotated back below there. In November, we very briefly tipped above 70% before rotating lower, and that's what I might look for on that chart there. Last thing, and we'll have to leave it here, is looking at the on-balance volume. I don't use a lot of volume in my work, as you probably notice if you've watched this show for a good amount of time, and I've got lots of reasons why that is not something that's super important to me. And at some point, I'll share some more details on why that's the case. However, I've always learned to pay attention to a number of different inputs and focus on where there may be a signal here. What I'm noticing on the chart of the S&P with the on-balance volume is, if you look here in November and December, you're seeing the S&P making higher highs, but look at how the on-balance volume has really not gotten higher than it was in November. So what that's doing is it's looking at the daily volume reading versus the movements in the price, and it's saying that there's heavier volume on the down days than the up days. So it's not just about today's sell-off. There's actually been some internal weakness. If you look at the volume on the down days versus the up days, well before today, it's been going on for the last 6 or 7 weeks. It might be an important chart to watch in a non-confirmation of the S&P attempting to go higher on weaker volume readings. We need to wrap to today's show and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is looking at AT&T. We didn't talk about this one yet, boys. As I told you, we have so much to talk about. We got to as much as we could, given the movement that we saw today. But I did want to notice, I'm often screening for stocks making new swing highs and new swing lows. I'm noticing AT&T coming up on my screen of new swing highs, getting above some of these highs from the fourth quarter of last year. But what really stood out to me is this bullish momentum divergence. Now, this is not the type of chart I usually love to pound the table on, because a chart going downwards, when price is going lower, I'd much rather lean away from that than lean into that, because it tells me price is probably going down for a reason. But if you notice what happened here, early December to mid-December, lower price, higher momentum reading. Ideally, that second one doesn't get below the oversold level around 30. It's just right there, but that shows you that the price is going down on lesser downward momentum. And it's interesting to see how AT&T has bounced since then. Currently today, testing that first Fibonacci resistance level. Now, the reason why I started with that first chart is look at the social media ETF, ticker SOCL. Now, a couple observations here. Number one, this chart has been in an established downtrend. So when we talk about the FanMag stocks rolling over, we talk about the growth trade maybe not starting to work. Remember, some of these names, these are a lot of communication services names. These are basically the communication services stocks you probably don't want to own up until today. It's things like Meta and others in that sector. But a lot of these have been in fairly established downtrends, things like Tencent in Hong Kong and others. So look at the extent of this downtrend, but potentially starting to see a bullish momentum divergence, lower lows in December into early January, potentially higher lows, and we'll see where the sell-off finishes and where the momentum reading finishes. But this is a group that has been dramatically underperforming, potentially getting a bullish momentum divergence and maybe a chart to watch. Finally, I really appreciated Jesse Felder's take on interest rates. It's hard to disagree with some of his points, and I love that relative strength of small versus large. Here I'm actually doing value versus growth. This is looking at small cap value versus small cap growth. Look at how that's making a new high in the ratio, and look at how 10-year yields getting above 170, 175 is the key level to watch there. Folks, that is our show. Thank you so much for watching us every weekday after the close for the final bar. Special thank you to Jesse Felder from the Felder Report joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.